All right, good morning and welcome to the latest of the Wednesday webinars. 100% Impact Investing, how to make all your wealth impactful and sleep well at night. As usual, it's brought to you by Fledge and Aviary, and I'll talk about them later. First, a wee bit about me. I am Looney Libis. I'm a serial entrepreneur. Spent 20 years of my career in the tech field, chasing down maximal returns, chasing down profits, chasing down the normal story you read about in the paper. And then I had a big switch in 2011, 2012, when I discovered that it was possible to do good in the world through business instead of through philanthropy. And through that, I started teaching at Pinchot University, started Fledge, the Conscious Company Accelerator, and Aviary, a Conscious Seed Capital Fund. Also, in the last bit, I joined a group called Tonic. So history was 3 years ago, a group in Seattle came together. It was the Seattle Impact Investors Group. And we came together to figure out how to do 100% impact investing. And soon after that, there was an international group called Tonic. Tonic at the time was an international angel group for impact. And they did a pivot, as lots of startups do. And they pivoted to be impact investing, a peer learning group for all types of investing. Out of Tonic came another group, or a subgroup in there. It's called the 100% Impact Investors Group. And they are a set of investors who not only do impact investing, but have pledged to make 100% of all their wealth impactful. And that's what I'm going to talk about today. It's a subset of Tonic. There's about 250 Tonic members, and about 100 of us are 100% impactors. All right, so a few weeks ago, I did this talk that described how investing and philanthropy are linked together. How this guy, Andrew Carnegie, about 100 years ago, world's richest capitalist ever, how he took this normal idea that you want to make as much money as possible, right, in the investing side. And then he invented this idea that then once you have a large pile of wealth, you create a foundation to give it away and set this foundation up in a way that it can last forever. Right? That was an invention of Carnegie. And from that, we get the modern view of having two pockets, of having the investing pocket, which tries to make as much money as possible, and then the philanthropy pocket of giving away 5 or 10% of that money per year or ever to do good in the world. All right, and I just want to point out one more last time, that was an invention. That is an idea that did not exist 200 years ago. It's something that Carnegie came up with. So here's how investing and philanthropy are actually linked together. They're sitting on a landscape where left and right is impact, right? So in the investing side, in the traditional model, you don't care about impact, you just care about return on investment, which is the up and down path. And in philanthropy, right, in the traditional philanthropy path, you don't care about return on investment. You're trying to give away your money. You don't want that money back. But what we have in the modern world is this idea of impact investing, which is a blend of those two pieces. So you want to put your money at work, but you would like it back with some return. And where you land on this landscape depends on is where the return is, right? The higher, the better. Right? Top right corner would be ideal. It's a huge amount of impact and a great return on investment. All right. One thing missing on that landscape is risk. What you see when you talk to an investment advisor or you read about investing is that it's a risk-reward ratio, that there's two axes, right? You still have this up and down axis of reward or return on investment, but the other axis is not impact. The other axis is usually risk, right? The riskier your investment, the better the reward should be. All right, so pulling off the internet, you search for risk reward, you get lots of pictures that look like this, right? So these boxes represent what's called asset classes, or in this case, yeah, more or less asset classes, right? And so cash is supposed to be the lowest risk return, right? You're supposed to be sitting in a savings account, it's insured, you're not supposed to make much return on that. Bonds are the next level up. You take a little bit more risk, but you should get your fixed percentage rate back, but it's going to be a small, these days, a very small single digit. And then up and up and up, right? Property is less risky because it's a physical asset. If something goes wrong, you still have the property, all the way up to shares in a private company where you can't sell them whenever you want, right? In fact, this chart seems upside down because I think what they meant by shares was public companies, Private stuff's usually falling in alternatives. But anyway, that's the basic idea. The problem is that it's bunk, right? That's a really good theory, but in practice, it doesn't work. So this is the actual return by asset class over a 14-year period. So we don't have 2015 and we don't know 2016 yet. And this one's mostly just stocks and bonds, but REIT in there is real estate investment trust. So that's real estate. And cash is in there, right? And AA, I think, is the whole portfolio. And one thing that pops out when you look at this chart is look at where cash falls, right? 2000, 2001, 2002, and 2008. Cash was in the top four. And yet that is the low risk, low return category, right? And somehow in 2000, cash returned 5.8%. Don't exactly know how that goes. And real estate is supposed to be a lower risk, lower return, and yet REIT shows up at the top of the list almost every year, right? Top or second, and except when we had the crash of the real estate market in the U.S., in which case 2008 you would have lost a third of your money investing in REITs, and so forth. And so this risk return ideal that they talk about in the investing world doesn't come true. Right, and you can read the rest of this chart. Again, you can look up this one on the internet. There's 100 versions of this chart up there. And so, the conclusion there, just on that piece, is that don't always listen to what everybody talks about. Right, just because you can find 100 investment advisors who will all spout that piece about being diverse, being in lots of asset classes, and playing with the risk reward ratio in order to protect your money in the ideal manner, just keep in mind that it's wrong. It's bunk. It's a myth. It doesn't come true. All right, but there's another one out there that's much more interesting, which is the impact investing thesis. All right, so in impact investing, we really don't look at risk reward, or we shouldn't, because it doesn't work. Instead, what we should look at is how much good can we do with our money, and underlying all that is this basis that it is possible to do good by using money, right? It's do good by doing business, and as capitalists, as investors, we're going to provide the capital to do that business. All right, and so what this really means is that and you can hear about this in previous webinars, the world of doing good is not left to the philanthropists and the nonprofits, that it is possible for a for-profit company to do good in the world by embedding a mission in its product or service, doing business, and doing good, falling out the back end. And you can see this in Whole Foods, you can see this in Zipcar, you can see this in Ben & Jerry's, you can see this in a lot of for-profit companies these days. It shouldn't be a surprise anymore. All right, and furthermore, when people say impact investing, that term often in most circles falls down and means angel investing. Or in other circles, it means responsible investing in public companies. In other circles, it means micro-lending to the poor. What you should take away is that it means all of these things, right? Impact investing is about the thesis of doing good in the world through money. It's not about any specific asset class. Okay, so the last and finally, before I get to the asset classes and how this works, is just ask yourself the question of what is your money doing when you're sleeping at night? Right, it's doing something. If you put your money, unless it's under your mattress or sitting in a vault as cash, it's doing something. Right, someone is controlling it. Someone is putting it at work. And the question is, what is that? All right, when you're all done, and you've put together an impact portfolio across everything, it could look something like this. Right, and I'm not going to go through this in great detail. This is a graph from the K.L. Felicitas Foundation, which is Charlie and Lisa Kleisner, who are the founders of Tonic and big players in the world of impact investing. And Charlie's the inventor of the 100% impact movement. Right, so this is what they published online as a report from a few years ago on how their portfolio breaks down. And so what you can see here, if you look at the inside, is that they have cash and public equities and fixed income, and they even have hedge funds and private equity. That's their asset classes, and then they break it down further into different categories. right, so let's talk about these specific asset classes. First and foremost, let's just start at the bottom of that risk-reward ratio, which is cash. Right, and by cash, we generally mean cash or cash equivalent, anything that you can turn into cash in the world of impact in a week. A week would be fast enough. All right, and so I have a history here. In 2008, I had a savings account and a checking account in a big American bank, right, Washington Mutual, one of the banks that was too big to fail until one day. I woke up and I no longer had my money in Washington Mutual. It was now in Chase Bank because the government had seized Washington Mutual. And thanks to the insurance, it was still the same amount of money the next day. Right? In the old days, back in the Depression, I just would have woken up and all my money, all my cash would have been gone. Right? And if I lived in other countries, in Argentina, one day you woke up and all your dollars had been seized. Right, all your pesos were still there, but all your dollars had been seized. Right, so cash sitting in a bank is not always the safe, insured, too big to fail piece that we're used to these days. All right, and these days, what's happened since the housing crisis is that the giant banks have gotten much bigger, and now in the U.S., what's called the giant banks, which is Chase, Citibank, Wells Fargo, and about two others, are now almost 2/3 of the banking system. And the small banks and the medium banks and the large banks, which are the other colors, are now about 1/3 of the system. And so if your money is sitting at Morgan or Chase or Citibank, the question is, what are they doing with it? And so an interesting fact, which you can again find in a bunch of different charts online, is that the small companies don't have access to that money in the big banking system. That the big banks don't lend money to small companies anymore, with rare exception. And so it's back to the small banks and the medium banks and the credit unions as the only path for small business to get money, which is fine if you don't care about small business. But small business is the ones that make the economy run and make your local neighborhood different from every other local neighborhood. And so this is a problem. And it's a growing problem that's only getting worse as the giant banks get bigger. The way you can address this, and this is the pattern I'm going to do in this talk, is here's the problem, here's how the asset class works, and here's the impact solution. Well, the impact solution is simple. You move your savings to local credit unions or smaller local banks. And so I have my money sitting at Seattle Metropolitan Credit Union and Beneficial State Bank. And what also falls out of this, which was an unexpected side benefit, is that the customer service is out of this world. Right? It's what you expect from a bank, as opposed to. I'm just checking the slides. All right. It's the kind of customer service you expected from a bank in the first place, as opposed to the faceless, as opposed to the normal practice you're used to when you walk into Chase or Wells Fargo. All right. The next asset class is just called fixed income. It's anything like debt where you put some money in and they pay you a little bit of money back over time. Right. So it's money market funds and treasuries and municipals and corporates. And people were chasing down. Right, you wanted a little bit higher yield a few years ago. That's the Puerto Rican flag, because their municipal bonds were paying better than others. I went on Fidelity on Monday to make this slide and was just flabbergasted that there were 58,000 bonds I could pick from on the market at the moment that day. There were only 288 new bonds I could pick, but existing bonds I could buy from someone. There were 58,000 individual bonds to pick from. And you can see the breakdown on the bottom there. And when I went to the corporate bonds just to see what they were paying and who they were from, it's kind of interesting because most of them, right, I kind of handpicked these for names we might know, but most of the bonds in there were from private equity firms, from oil and gas firms, from banks. I found one insurance company. I found Ford pretty far down the list, and you can see they're having a hard time borrowing money because they're paying 8.9%. Hotel, And I don't know why Kinder Morgan. I guess that bond must be old because it's only 3.9%. And those are the list prices, not the current prices. So again, if you are an investor and you have your asset allocation and some of it's in fixed income, you probably own some of these bonds in some form, either directly or in a bond fund, because this is what's out there. And in this case, they're taking that money, right? So you can be funding the oil and gas boom, or you could turn to an impact fixed income, and you can own a CDFI, which is a kind of like a bank without all the banking regulations, but they lend money to small local businesses. There are green municipal bonds now. My state of Washington just issued those, I think, this month. And then there are organizations like Calvert and Community Investment Management, which have funds for doing fixed income. Finca does micro lending. Alder Fund is a local Seattle group that does green building. There's a bunch of options out there. The trick is trying to find them. In the public equities, right? So these are the big companies we all know and hear about in the news, right? So the benchmark there is the S&P 500. And it's had a pretty good run over the last 100 years. And even over the last 30 years, it's had an incredible run making money. And in terms of public equities, the movements that people are making in the impact space, they take 3 baby steps. First step is called divestment, right? And this was invented back when South Africa still had its, still has issues, but still had its bigger issues. And it was the idea of just not buying any company that was helping support that. These days, divestment is in oil and gas, tobacco, and alcohol. So you can turn to your investment advisor and say, I don't want to own any oil and gas stocks anymore, right? In which case, you can't own the S&P 500, right? You can't buy an index fund on the S&P 500 because Exxon is still way up near the top, as are lots of other oil and gas companies. As are tobacco and alcohol companies. So as soon as you go down the path of divesting, you no longer can simply buy the index straight up. You have to make your own index. Baby step number 2 started out with the term corporate sustainability, or CSR. And this is the idea of rating how sustainable a company is, right? What they do and how they do it, and put a number on that and pick the companies that are more sustainable. The latest version of this is called ESG, or environmental social governance. And again, there's a system that can rate each company. There's lots of systems that can rate each company on how environmentally conscious they are, how socially conscious they are, how they govern their company in terms of, is it a mix of genders on the board of directors? This showed up in the tech world last year, right? What's the breakdown of male, female, white, black, Hispanic, and so forth inside the company? And simply how do they treat their employees and their governance? You can see these ratings today. There is at least one public version on Yahoo. So if you go to Yahoo Finance, put in your stock symbol and hit profile, you will find a corporate governance section. Right, this is kind of an edited page. It doesn't look exactly like this, but here's Apple, and you can see they get a pretty terrible score. Right, and so their compensation's good. It's a 1 to 10 scale, and they're getting a general score of 1. And you can see this for 2,000 companies that are all public. Right, and for impact investors, a lot of them will go and look at these scores and filter out which companies they'll invest in based on ESG. There's also a friend of mine runs a company called CSR Hub, which takes 469 of these standards and mixes them together to give you more information about each company. They generally sell their product to investment advisors. But what was telling about this, which is screenshots from their webpage, is that there are 469 different data sources for CSR and ESG now. And I remember when I first started chatting with Cynthia from CSR Hub, I think there were a dozen. And so this is definitely picked up and people are caring, but there's no true standardization about what these numbers mean, right? Not if we have 469 options. Personally, I keep talking about this like I don't do it. I have an issue, and so do a lot of other people, with what it means to be an impact investor in a public equity, in a public company. Because if I bought that Apple stock today, no money goes to Apple. Right? If I buy the bond when it's new, the money would go to, if I bought an Apple bond, it would go to Apple. But if I buy a share of Apple stock, $0 goes to Apple. I'm just buying it from someone who already owned it. And so the question comes down to what does it matter? What does it matter if I own that stock versus someone else owning that stock? And what does it matter if I'm owning Apple or Exxon or Philip Morris versus Tesla or Whole Foods or something where the company's a little more impactful? And no one has a really good answer to this yet. The best answer I've heard is that you can make a difference, right? That these companies that are not scoring well on ESG right now could change their mind and could start doing better internally and externally. And one way they might do that is by having investors that tell them to do that, right? They're supposed to be beholden to shareholders. That's definitely the paradigm these days, is maximize shareholder value. And if shareholders tell them that they need to treat their employees better, that they need to not pollute, that they need to be more healthy or whatever, they may actually do it. And so there's a movement to buy shares in companies that themselves are not doing well and be loud. Moving on, real estate. These days, most people buy real estate, do investing in real estate through REITs, right? That's real estate investment trust. It's a tax structure for buying real estate in a fund. There are lots of public REITs out there. And I did an internet search and just asked for the biggest. And so this is apparently the list of biggest REITs. And you can see, you can buy malls, you can buy strip malls and big malls and apartments. And there's lots of REITs that own healthcare real estate or hotels. Public storage, that pretty ubiquitous storage company out there, is a REIT. It's actually not a company structured like a normal company. It's structured as a REIT. You can own their real estate if you want. In the impact space, right, you can think of that, is owning a local mall impactful or not? Your other options in the impact space would be owning things like affordable housing. And so this is a 71-unit affordable housing apartment building in Seattle run by a group called Bellwether Housing. Or maybe it's just about how the buildings are built. And so this is the Cove, which is a LEED Platinum building. And there's a group that goes around building these LEED Platinum buildings in Seattle and Portland, and you can be an investor in a mixed-use building like that. There's a bunch of options out there in the impact space for whatever your impact is. And as you should see, as I go through this, it's kind of nebulous, right? There's no one answer for what impact is or what impact investing is. It's up to you to determine whether or not that specific investment falls into impact or not. All right, and lastly on this tour of investing would be private equities, right? Which is generally startups, and so this is where I spend most of my time, right? And so this is a few pictures of some fledglings here, and I've talked a bunch about private equities in the last webinars, right? So You're Doing It Wrong, which was the first webinar, is talking about how to invest in these startups and how to measure what you're doing in terms of startup investing as impact. The key is, of all the asset classes, personally, I find that the startups are the easiest ones to understand in terms of, are they doing good or not? Because you can look at what the company does as opposed to just how they do it and determine whether or not what they do falls into your bucket of important impacts of the world. Right? And so, if they're addressing poverty, that's pretty clear. If they are selling, an internet service, it's a lot less clear. But you can make that judgment yourself on those private equities. But of course, higher risk, less liquidity, and you can't put all your money in private equities. So in short, impact investing is a philosophy, right? We used to hear this a lot in these circles of investing, that impact investing was an asset class that you should have 5 or 10% of your money in impact investing. That's a weird way of looking at it. Impact investing is just a way of looking at all investing. All right, and hopefully today you've gotten your eyes open a bit that there are lots of options in every asset class for impact. Right, every dollar you own can do good in the world. right? Every dollar in every place it can possibly be can do good in the world. And you don't need to do 100% or nothing, right? You can say, I am going to start dabbling and I'm going to take 10% of my wealth and move it over to impact, or I'm going to take my public equities and I'm going to start divesting or start doing ESG or start doing something else and make that asset class more impactful. Or I'm just going to start with cash and I'm going to take my cash out of Charles Schwab and out of Chase and I'm going to put it in a credit union. And if you do this for enough years, and the Kleisners have been doing it for about 10 years, I think, you'll wind up with a portfolio that looks something like this. All right. And so if you're interested in diving in much deeper, you can point yourself to Tonic and read up about their 100% impact investing network. And as always, these webinars are brought to you by Fledge, which is an impact accelerator or the conscious company accelerator, depending on whether you're viewing it from an entrepreneur point of view or investor. We announced 3 weeks ago that we're doing Fledge 8 in Lima, Peru in October. Big change for us. We've been doing all the sessions in Seattle, but we're starting to branch out and replicate the program elsewhere. And the webinars are also brought to you by Aviary, which is an impact seed fund. Seed fund as in early stage private companies. And we will be investing in the best of fledglings and the best of other graduates from other accelerators as soon as we're done being funded by impact investors. All right. One more webinar on the list before we take a break, which is the catch-22 of investing. It's called Novel But Certain. Right? This is the idea that investors are attracted to interesting, innovative ideas, but at the same time, they want ideas that definitely work. And that's a catch-22. So I'll talk about that next week. And then we'll put the webinar series on hiatus for a while because SoCap is coming up in September. That is the Social Capital Conference, or really the Impact Investors Conference. Biggest one in the world, happens every September in San Francisco. If you've never been and you want to be an impact investor, highly advise that you go. And then 2 weeks later is the 100% gathering for Tonic in Park City, Utah. And so I'm going to be on the road a lot in September, so I'm putting the webinars on hiatus. And with that, I will turn off the recording and open this up to questions.